$1 million is a lot of money, and it feels like there's no way that any normal person is able to have $1 million. But I'm gonna show you exactly how much money you'd need to invest into SCHD Dividend ETF in order to grow to $1 million. All right, first let's talk about what SCHD. It is the Schwab U.S. Dividend Equity ETF. It owns all large cap value stocks that are dividend paying stocks. You can see it has an average price to earnings ratio of 12.73, has a dividend yield of 3.72%. And I'm going to tell you why this is a great time historically to be buying into SCHD. And you can see here, you get diversified into more than 99 companies. This fund invests in more than 99 companies, so you're not heavily concentrated in any one individual stock. And then the largest position size you're gonna see, this is also how they reduce risk, is right around 4%, maybe 4.5%. And here are their top 10 positions: Merck, Amgen, IBM, Pepsi, Pfizer, Lockheed Martin, Cisco, Texas Instruments, the Home Depot, Coca-Cola, Broadcom, Verizon, Automatic Data Processing, BlackRock, EOG, Altria, 3M, Illinois Toolworks, US Bank Corp, and Valero Energy. So we actually went through the top 20, right? Why do I feel great about this fund? Well, it's actually got a pretty decent track record of success and actually beating the S&P 500, and it's a little bit more conservative, which is crazy. So year to date, this fund is only down 6.75% compared to the S&P 500, which last I checked was down more than 10%. I'm not sure exactly what it's down right now. Over the last 3 years, on average, it's up 13% per year. Over the last 5 years, it's up 12% per year. And over the last 10 years, it's up 13.3% per year. Okay, so I did actually hop over to VOO. This is the S&P 500 and Vanguard's pretty much most famous ETF. Year to date, it's down 19%. Over the last 3 years, it's up 8.7% per year, but that's below SCHD. And over the last 5 years, it's up 9.7% per year. Over the last 10 years, 12.43% per year, right? So SCHD is winning over the short and the long term compared to VOO. I'm going to get to the calculation, tell you exactly how much you need to invest into SCHD based on its historical performance to reach that $1 million mark. But I want to talk about risk real quick. It gets a below average risk rating from Morningstar and a high return versus the category. That's an incredible combination. And it's because of this powerful dividend growth that we see in dividend paying companies that we see. And we can see that the maximum drawdown, this was during the worst part of the COVID crisis, it was down 21%, which is actually pretty amazing when you consider that other parts of the market were down 30 and 35%. This is what makes this ETF so special. It has a process, a systematic process for picking its stocks. It's not just the emotions of some fund performer. They focus on not only dividend paying stocks, but dividend growth stocks. Historically, stocks that are growing their dividend over time are the best performing stocks as an entire group in the entire market. And they are also a lot less volatile and risky because companies that are growing their dividend are healthy companies. And so this is exactly how this fund picks stocks. Okay, so it draws from Dow Jones U.S. Dividend 100 Index, which selects its companies from the Dow Jones U.S. Broad Market Index, which covers the broad U.S. stock market but excludes REITs. So you're not going to get any REITs. Then the index filters out stocks that fall short of liquidity requirements. This makes it less risky. If they have market caps smaller than 500 million, it will not own these stocks, or if they have not paid dividends for at least 10 consecutive years. It ranks stocks that meet these criteria by indicated annual dividend yield and screens out those that rank in the bottom half. So it is filtering out everything except for the best dividend paying stocks. The remaining stocks receive a composite score that equally weights 4 metrics: cash flow to total debt, return on equity, yield, and 5-year dividend growth rate. This is what makes this so special. These categories that it grades them against. The index ranks stocks by the composite scores, and essentially that's how it selects the stocks that are in the index. So you don't have to worry about concentration risk. It keeps a filter for high quality companies, and you can sleep well at night knowing you own a bunch of high quality dividend paying stocks that have historically grown their dividends. All right, we're getting to the calculation right now. So again, We're looking at we'll go with the 5-year growth rate of 12% per year, right? This is the IRS investment calculator. We are starting with a $0 investment. We're doing $2,500 a month, which sounds like a lot. I know, I got it. But think, if you're just starting your career now and you can increase your investment over time, then the goal is to be able to get to $2,500 or more per month over your career. If you can do that for 20 years, 20 straight years, not getting scared in and out of the market, 20 straight years. We're going with an estimated 9% interest rate, right? So I wanted it a little bit below the historical average that this fund has done, but we have a variance of 3%. So this is going to give us 12%, 9%, and 6%. I'm going to hit this. It's going to tell you exactly how long it would take if you made 6%, 9%, or 12% annual return and did $2,500 a month, exactly how long it would take to become a millionaire. Okay, here you go. At that 9% rate, in 20 years, you would have $1.5 million if you did $2,500 a month and made 9% per year. Now, let's say things go really well and it earns 12% per year. At year 15, you would actually have $1.1 million. If you made that 9% per year on average per year, which is about the average of the stock market over the last 150 years, then at year 17, at 9%, you would have $1.1 million. And finally, say it's a historically bad period of time for the stock market and you make 6% per year. Then investing $2,500 a month in year 19, you would still hit your goal of $1 million. If you're starting at age 21, in the worst case scenario of this setting, when you were 40 years old, 19 years later, you would be a millionaire. That's the power of long-term investing. Now, say it was incredible, in an incredible 20 years, and you earned that 12% per year. You stuck with the $2,500 a month. You would have $2.16 million. At 9%, $1.53 million, and at 6%, $1.1 million. This is the power of investing. Now, let me show you why SCHD is my absolute favorite dividend ETF. It has not only a 3.37% dividend yield, which you can see all ETFs, the median is 2.27, so it beats those by 48%. It has a 5-year dividend growth rate, meaning it pays you more in dividends every single year, a 5-year compound annual growth rate of its dividend at 12%, which is 88% higher than the median of all ETFs. Over the last 10 years, it's even better than that, 16%. And then for 9 straight years, it's had 9 consecutive years of dividend growth. How does it do that? Well, it owns position in underlying stocks that increase their dividend over time. So as those stocks increase their dividend, the dividend gets higher for this fund. That's why this is better in every sense, in my opinion, than a covered call writing ETF that might pay a 10% or 12% dividend or something crazy like that. Those aren't reliable, and then the performance of the fund is terrible compared to SCHD. Okay, so this is an income forecast, right? We talked about what the total portfolio value would be over that time period. Let's talk about what your dividend income would be if the trends stayed the same. This is starting with pretty much $0 in SCHD and adding $2,500 a month, so that's $30,000 per year. And it's actually using a 10% dividend growth per year, which is lower than its 13% or so 5-year average. But then we are reinvesting the dividends because we don't need that money, so that gives us the 3% boost every year, which puts us right here at this yellow number. And so if we're adding $30,000 per year, which yields us our 3.36%, we're getting that dividend growth and we're reinvesting the dividend, then by 2042, we saw how much the portfolio would be valued, right? Somewhere $1 million, $1.5 million, whatever. We would also be pulling in around $80,000 a year in dividend income. And so just think about how powerful of a situation that would be. And a 21-year-old starting would essentially be what, 41 years old with over $1 million portfolio, maybe somewhere between $1 and $1.5 million portfolio, and somewhere between, we'll say, $70,000 to $90,000 in dividend income just off that portfolio, and they're still in the prime of their working career, or they could retire and do whatever the heck they wanted. And let's just do a quick comparison. These are about 5 of its peers. We have SCHD, DVY, DGROW, VYM, HDV, and SDY. These are all dividend-paying ETFs. And you can see when you look out, they're all actually doing pretty well, I mean, compared to the market, right? So, I mean, these might be good options for anybody if they're looking for dividend stocks. But over 3 years, SCHD really starts to outperform, up 30% versus the next highest one is DGROW, up 20%. Over 5 years, it's up 50%. versus DGROW, that's the next highest, up 45. And over 10 years, it's up 158% versus the next highest is VYM, which is Vanguard's, up 113%. Let me know if you love SCHD in the comments, or if you have another ETF you want me to evaluate, or if you have one that's your favorite. If this content is helpful and valuable to you, it helps support me if you like the video and subscribe to this channel. Those both cost you nothing and really help me grow. I really appreciate you doing that.